Most people don't actually lose money in the stock market because they are wrong. They lose it in the gap between what they thought investing was and what it actually is. That gap has a real cost, and it's measured in dollars and years. You just downloaded a brokerage app. Maybe it was a random Tuesday. Maybe you saw a meme online, or a coworker mentioned a stock and the name stuck. 3 days later, you're staring at a clean green and white interface, asking you to link your bank account. You deposit a small, round number, like $20 or $50, because it feels like an amount you can afford to lose. You aren't wrong. You can afford to lose it. What you can't afford yet is knowing what that loss is going to teach you. At this stage, the market doesn't even know you exist. The platform's algorithm chunks your account into a tier that generates zero meaningful revenue for anyone. Your $20 isn't being managed, it's just sitting there. If you bought anything, it's a tiny fraction, maybe 0.18 shares, of a stock trading at $280. When your portfolio goes up 40 cents, you get a rush that's hard to describe but makes you want more. When it drops 62 cents the next morning, you check the app 4 times before lunch. You aren't investing yet. You're just learning what it feels like to have skin in a game whose rules you haven't fully read. This education has started, and it's going to cost you a lot more than $20 before it's over. Something changes. You add more money, not because someone told you to, but because the idea stuck with you. You have a few $100 in the account, and you've made 2 or 3 actual trading decisions. Your positions are small, and the gains or losses amount to coffee money. But psychologically, you're no longer just a saver. You are an investor with active positions. This is where the first real loss happens. Not a catastrophic one, just a $47 or $93 hit. You bought something because it went up for several days straight, assuming it would keep climbing. It didn't. It dropped 9% in a single day, and you watched it happen in real time, but refused to sell. Selling makes the loss real. Keeping it on paper keeps it theoretical. This isn't stupidity. It's a completely normal human response to a paper loss. But if left unchecked, this exact mindset is what turns a $93 loss into a $340 disaster. Your opinions at this level are your most dangerous asset. They are built on a few months of paying attention, a couple of articles, and a podcast or 2. They feel solid, but they aren't. What saves you here is simply not having enough capital to do real damage. The tuition is cheap, but the lesson is mandatory. Now the number in your account is large enough that losing a big chunk of it would genuinely sting. You aren't playing with house money anymore. You are playing with hard-earned savings. This is where most people pay what's known as the learning tax or market tuition. Some call it their crypto phase, while others don't name it at all because counting the cost hurts too much. The learning tax is what you pay to discover the brutal gap between what you believe the market would do and what it actually does. You try a specific strategy, like buying stocks that drop 20% in a week, assuming they'll bounce, or following an online influencer, or doubling down on the sector you work in. The strategy works 2 or 3 times. This is actually the worst thing that can happen because it builds false conviction in an unproven method. When the strategy inevitably fails, it wipes out all your previous wins and then some because you sized up your positions right before the crash. A 15% drawdown on a $3,000 account is $450. That takes real time to rebuild. Building feels like forward progress. Rebuilding feels like running in place. You aren't building wealth yet. You're building a dataset of how you personally behave under financial pressure. Whether through market gains, time, or your income, you've hit real capital. These milestones require actual calculation rather than gut decisions. It's the difference between a scrimmage and a real game. You've watched the market long enough to notice trends, like how stocks behave during earnings season. Your emotional response to volatility changes. When a massive wave of panic hits the market, you no longer react instantly. That 48-hour delay between the urge to sell and the actual execution is incredibly valuable. Most retail losses happen in the first 48 hours of a market dip. Fees become visible for the first time. The difference between a 0.03% index fund and a 0.75% actively managed fund looks like a rounding error. But when you compound a $20,000 position annually at an 8% market return over 20 years, that tiny percentage difference amounts to an $18,000 gap in net returns. The market still doesn't care about you. You are a retail investor whose trades are absorbed instantly without a ripple. What matters at this level isn't being seen by the market. It's seeing the market more clearly than you ever could before. This is the exact moment when compounding stops being a textbook concept and becomes a physical reality. Your account makes more money this month from pure market movement than you actually deposited. At this stage, your behavior dictates your wealth more than any external factor. If two investors start this phase with the exact same amount, they will end up in completely different places, based solely on how they handle an 18% market drop over 6 weeks. One will hold. The other will panic sell to cash to stop the bleeding and completely miss the market bounce. Market recoveries don't send out press releases. They are only obvious in hindsight. The brokerage platform starts algorithmically targeting you. You get approved for margin capability and advanced options trading. The platform doesn't care if you lose money using these tools. They just want the transaction volume. It is up to you to use them safely. Taxes become a major factor. The difference between holding a position for 364 days versus 366 days is the difference between short-term capital gains, taxed as ordinary income, and long-term capital gains, taxed at 15%. On a $15,000 gain, that is $2,000 to $3,000 of real money staying in your pocket. You are finally learning the actual geometry of the game. This number carries serious structural weight. With $150,000 invested, you are now in the top 10% of American investors by account size. Most people who start never get here because they quit when the future felt too abstract to keep going. When the topic of money comes up in a room, you aren't quiet anymore. You have the vocabulary, the context, and the scars of real financial decisions. Your knowledge is compounding right alongside your capital. You now qualify for premium brokerage tiers. You get better fee structures, institutional-grade data feeds, and deep analytical tools that used to be sold exclusively to Wall Street firms. You aren't in the institutional room yet, but you can see the door. You are dealing with licensed professionals whose advice is calibrated for an adult with serious capital, not a beginner. Serious money attracts serious mistakes. This isn't the $93 tuition of the early days. This is a $30,000 concentration error. It's putting too much money into a single stock because your deep research made you overconfident, costing you 3 years of progress. The market doesn't care how sophisticated your thesis was. It only cares if you are right or wrong. You cross this line without any email, notification, or status change. The number just updates, but the asymmetry of your life shifts completely. A 10% gain on $400,000 is $40,000, which is more than the average American household saves in an entire year. Your investment portfolio is now generating wealth on a scale that standard income-based strategies cannot touch. The abstraction is gone. The math is concrete. Private wealth management becomes genuinely available. Elite advisors actively compete for your business, and fee structures become negotiable. As an accredited investor, you get access to private equity funds, hedge funds with $250,000 minimums, real estate syndications, and structured products that never appear on retail apps. The anxiety shifts from survival to preservation. You stop thinking in months and start thinking in decades. The question is no longer whether the account will grow, but what legacy you are building it for, and if your strategy can survive the test of time. Millionaire is a word that carries massive cultural hype. But in today's economy, there's a major gap between the myth of $1 million and its actual purchasing power. You get about 72 hours to sit with that realization before the practical reality of managing it takes over. The myth fades, the math stays. Once you clear $1 million in liquid assets, you are no longer a retail investor. Private banking relationships become standard, and consumer brokerages are replaced by institutional-grade custody solutions. The conversations change completely. Advisors are no longer pitching you stocks. They are mapping out estate planning, trust vehicles, generational wealth transfers, asset protection, and tax optimization across corporate entities. Your trade sizes are now large enough that market execution matters. Placing a sloppy market order instead of a timed limit order on a $200,000 block position can cost you thousands of dollars in slippage. Institutional brokers give you direct market access because your volume justifies the red carpet. The infrastructure around you gets better, but the pressure doesn't disappear. You get better analysis and better legal shielding. But the final judgment is still yours. $1 million allocated into the wrong asset based on a flawed thesis is still a massive loss. The system won't protect you from being wrong. It just gives you better equipment for being right. $1 million balance doesn't change who you were at the beginning. Staring at your phone on a Tuesday, making a deposit that the system completely ignored. The market didn't care about you then, and it doesn't care about you now in any personal sense. What changed is not the market, it's your position within it. That position took years to build, required a painful lesson at every single tier, and requires constant maintenance. The journey from $20 to $1 million isn't a story about money. It is a story about developing a mature relationship with uncertainty. At first, you feared it. By the end, you've simply been in the game long enough to recognize its patterns, and that is as close to controlling it as you will ever get.